Hey everyone, my name is Deborah Rudd. Today I'm going to be talking about asset taxation during and after expatriation. I'm going to be focusing the conversation mostly on covered expatriates, and the reason for that is because they're the people who pay exit tax. If you're not a covered expatriate, you're not paying exit tax. And the reason that we're going into this topic in this presentation is that there's a lot more to it than just simply exit tax. There's actually 4 different types of exit tax that could apply based on what type of asset you're looking at. There's adjustments that need to be made for income and assets to be taxed after expatriation. And then finally, if someone gives away their assets or they die and they leave behind their assets and they're a covered expatriate and they're leaving or giving their assets to a U.S. person, then they could be subjecting that U.S. person recipient to having to pay a gift or inheritance tax. This is the opposite of how it usually works. Usually the person giving the stuff away is going to pay the gift tax, not the other way around. But for recipients of gifts from covered expatriates, they're liable for the gift tax. So let's get started. First, I want to take a look at an overview of expatriation, just so we have some context and kind of a roadmap for where we are in the conversation. We'll look at who can become an expatriate, how do you know you've become an expatriate, what are the 3 tests for determining covered expatriate status versus not covered expatriate status, what does it mean to be a covered expatriate, and then a summary of the topics we're going to talk about today. I'm going to be using this little flowchart throughout this first section. This is kind of our roadmap for where we are in this little part of the conversation. So look at the circle in red, and that's where we're at right now. So first, let's talk about who cares about these exit tax laws. The answer is expatriates care. And if you're not an expatriate, then none of this is going to matter to you. And the people who can become expatriates come from 2 categories. They're either citizens or they're what's called long-term residents. For the most part, if you're a citizen of the U.S., you know it. You were either born in the U.S. or you were naturalized as a citizen. In those 2 cases, you pretty much always know that you're a U.S. citizen. But sometimes there are situations like if the parents are U.S. citizens and the child was born overseas, where it can be unclear whether the person has U.S. citizenship. And if that's your situation, then you should probably not think about U.S. taxes just yet, and you should start with talking to an immigration lawyer. The other category of people that can become expatriates are what's called long-term residents. Long-term residents are green card holders who have had the status of lawful permanent resident in 8 of the last 15 years. So it's a count the years test. The reason I put in quotes is because that's a really important word. What it means is that if you had the green card for only 1 day out of the calendar year, then that year counts as a year in which you had your green card. So that would be 1 full year towards the 8-year test. Here's an example to illustrate that concept. Let's take a look at someone who received their green card in 2013. And it just so happens in this example that they received the green card on December 31st, 2013. That means they only had the green card for 1 day during the year in 2013. But because they did, that year, 2013, counts as 1 full year towards the long-term resident test. 2014 through 2019, they have the green card for the full year, so obviously those count. And then let's say, right now today, it's January 1st, 2020. If they still have their green card, then that means they've had the green card for 8 years of the long-term resident test because they've had it for at least 1 day in each of the last 8 years. That means in 2020 they would become a long-term resident, and if they were to give up their green card from that point forward, that would make them an expatriate. Now, if you're able to make a treaty election to be taxed as a non-resident alien for the entire calendar year for any given year, then you would not count that year towards the test. Let's take a look at how that works. We have the same exact example as before, except in this scenario, the taxpayer is out of the US for the entire calendar year 2015, and they meet all the requirements to be able to make a treaty election to be taxed as a resident of another country. So for 2015, we don't count that year towards the 8-year test. That means by the time we get to January 1, 2020, they've only had 7 years towards the long-term resident test, and they're not yet a long-term resident. This is a way that some taxpayers use to manage their long-term resident status so they can avoid becoming expatriates. One other thing to note here is that if you make a treaty election to be taxed as a resident of another country after you meet the 8-year test, then that itself would be an act of expatriation. So if you're using treaty elections to manage your long-term resident status, I would advise to tread very carefully and potentially work with a professional who really understands these rules just to make sure that you don't do anything that has any unintended consequences. So you have a citizen or a long-term resident, and the question is, how did they become an expatriate? And the answer is that they become an expatriate by having an expatriation event. So what is an expatriate really? It's when a US citizen or a long-term resident terminates that status. Citizens can terminate their citizenship by filing Form DS-4079 and taking an oath of renunciation at a U.S. embassy or consulate. And long-term residents can terminate that status by filing Form I-407 and turning in their physical green card. Note that letting the green card expire is actually not an act of expatriation. What happens if you do that is that you are still a U.S. taxpayer, you just no longer have the immigration benefits of having the green card. Next, we look at what it is that makes a covered expatriate. And there are 3 tests that apply, and also a couple of exceptions you can use to avoid 2 of the tests. The 3 tests are, first, is your net worth $2 million or more? If it is, you're a covered expatriate. Second is the tax liability test. Is your average tax liability for the 5 years before the year of expatriation $172,000 or more? If yes, then you're a covered expatriate. And lastly, the certification test. Did you comply with all your tax obligations for the 5 years before expatriation? If no, then you're a covered expatriate. If yes, then you're okay for that test. Let's take a look at a little graphic we have that shows how this works sort of in sequence and with the exceptions that might apply. So in this graphic, we've actually put the certification test first. And the reason we did that is because the certification test is the one test that you have to meet, and you cannot apply any of the exceptions to it. Basically, nothing can save you if you don't meet the certification test. You're going to be a covered expatriate. So that's what that red line is at the bottom that goes straight down from certification test and over to covered expatriate. But let's say you meet the certification test and you get to move on to the net worth test. So if your net worth is above $2 million, that's bad, but you get to go down to that diamond in the middle and see if an exception applies. Same for the tax liability test. If your tax liability on average is too high, you do get to check and see if an exception applies. There are two exceptions, one for being born a dual citizen and one for expatriating before age 18 and a half. If those exceptions apply, then even if you met the net worth test and or the tax liability test, then you can use that exception to avoid covered expatriate status. But if you fail any one of the three tests and you're not able to use an exception, then you end up in the red circle at the bottom right, covered expatriate. This is the section from Form 8854. This is Part 2, Section A, and this shows the three tests and the exceptions as they appear on Form 8854. Form 8854 is the form that you have to file to report your expatriation, and you send it in along with your tax return in the year following the year of expatriation. So if you're expatriating in 2021, then the 8854 gets filed along with your 2021 tax return, which is due in 2022. And in this section here, you can see on line 1, that's where you're entering your U.S. tax liability over the past 5 years, so that's the tax liability test right there. Line number 2, enter your net worth on the date of your expatriation, so that's the net worth test. If you skip all the way to line 6 at the bottom, that's the certification test. And the three questions in between that, 3, 4, and 5, those pertain to the exceptions that we talked about earlier. And I'm not going to go into detail about what the exceptions are and how they work because we just don't really have time for that today. But it's just important to know that they exist. So you apply those three tests, and then you see if you're a covered expatriate or if you're not a covered expatriate. And that brings me to today's topics. So here's what we're going to be talking about today. First, I'm going to go into some detail about the 4 exit taxes and how each of them works. Then I talk very briefly about post-expatriation income tax that applies to all expatriates. Essentially, you become a non-resident and you pay tax like a non-resident. Then I'm going to talk about some special income tax problems that apply to covered expatriates only, as well as some coordination rules that only covered expatriates have to worry about. And then lastly, I'm going to spend a little time talking about covered gifts and bequests. This is the thing I mentioned at the beginning, where recipients of gifts or inheritances from covered expatriates have to pay the tax. There's also a couple topics that are kind of important when you're leaving the U.S., and this applies whether you're expatriate or not. We don't really have time to go into detail on every item, but I just wanted to mention these as things to be aware of that we're not going to be able to spend time on today. First is a transfer of assets to a foreign trust is a mark-to-market event. So sometimes when a U.S. person ceases to be a U.S. person, that causes their trust to convert to a foreign trust, and if at the same time they are deemed to no longer be the owner of the trust assets, then they're considered to be contributing assets into a foreign trust under Section 684, and so that could be a taxable event. The other one is change of residence being deemed disposition of PFICs. This is according to a set of very old proposed regulations that have never been enacted into law, so it's a little unclear how much force these regulations really carry at this point. But again, it's something to be aware of if you have this type of investment. before you expatriate so you can figure out what to do with it. So, let's get started. First, let's talk about the 4 exit taxes that apply if you're a covered expatriate. I'm going a little bit out of order from how these appear in the tax code or in Notice 2009-85, which is pretty much our only other resource for how all this expatriation tax stuff works. But I wanted to go in this order because the last one is sort of a catch-all. So let's start with the ones where we have a specific definition for what they are. First is specified tax deferred accounts. Think things like IRAs. And these, their tax treatment when you expatriate is that there's a deemed distribution of the entire account value, no early distribution penalty, but it's still a taxable amount. The second is deferred compensation. And there's 2 categories of this, eligible and ineligible. Ineligible deferred compensation is taxed as a deemed present value lump sum distribution, and if you're able to elect the eligible treatment, you don't have to do the deemed lump sum distribution, and instead you just get 30% withheld from actual distributions. Third, trust distributions. 30% is withheld from the taxable portion of trust distributions when paid. This brings us to the 4th type of exit tax, which applies to everything else that wasn't mentioned on the previous slide. For everything else, you have a deemed sale and you recognize gain or losses, meaning that you pay tax on the gains and you may or may not be able to deduct the losses. The first, $744,000 of capital gain is exempt from taxation for 2021 expatriations. This amount is indexed for inflation and increases just a little bit every year. So let's get started with specified tax deferred accounts. So what are specified tax deferred accounts? This includes IRAs, Roth IRA, Coverdell Education Savings Accounts, Health Savings Accounts, Medical Savings Accounts. Note that it does not include SEP IRAs or Simplified Retirement Accounts because these are specifically designated as deferred compensation items, which we're going to be covering next. You can find all the rules for the tax treatment of specified tax deferred accounts under Section 877 Cap A, subsection E, or Notice 2009-85, Section 6. So how are specified tax deferred accounts taxed? What happens is that you have to pretend that the entire account value is distributed to you on the day before expatriation. There's no early distribution penalty because you didn't actually take a distribution. And note that the gain exclusion for mark-to-market deemed sales does not apply because this is not a mark-to-market disposition. These assets are specifically accepted from the mark-to-market rules, so you don't get to apply that $744,000 exclusion to these particular types of assets. Note that when you have this type of account and you have this deemed distribution, when you do take actual distributions later, you get to adjust your basis in the account to reflect the amount that's already been taxed. You specifically are told both in the code under Section 877 Cap A actually, and also in Notice 2009-85 Section 6 that you're able to make appropriate adjustments. And I'll talk about what that means a little bit later, but you're able to make these adjustments so that you're not taxed a second time, at least not in the US, when you take out the balance of this account. Next, let's move on to deferred compensation. This is the second type of exit tax that could apply to covered expatriates. This one, as I mentioned before, has a couple different types of tax treatments. Here's how this works. First, you have to look and see, is this a deferred compensation item? If it is, then you move on to whether it's eligible or ineligible deferred compensation. Then, once you know whether it's eligible or ineligible, that'll tell you how it's taxed. One rule that I always thought was a little bit surprising is this special rule for deferred compensation items. For exit tax purposes, you're supposed to pretend that the asset becomes transferable and that the substantial risk of forfeiture has lapsed on the day before expatriation date. That means that you have an income recognition event and tax to pay. The rule applies for exit tax calculations, but interestingly, it does not appear to apply for the net worth test. That means that you could potentially, unless I'm wrong about this, but I think that it means that you could have items that are not included in your net worth test. They're not included in your 2 million calculation. But if you happen to be a covered expatriate because of your other assets, then if you have any of these items, then you could be paying exit tax on them. One common example of this type of asset that I see in the US pretty frequently is restricted stock units. As you'll see in a moment, an easy solution to this particular problem, if the restricted stock units are from a US company, then you're probably able to elect eligible deferred compensation treatment, which makes the problem I'm about to describe on the next slide pretty much go away. But if you don't do this, then this problem is actually very real. Here's an example to illustrate what I'm talking about. I took this is actually pretty much word for word, except I put it in bullet points rather than a paragraph. But it's pretty much word for word from example 13 from Notice 2009-85. We have our expatriate, our covered expatriate, C. C relinquishes citizenship on December 17th, 2009. On December 16th, 2009, the day before expatriation, C had 100 restricted stock units from Corporation Z that are going to vest on December 16th, 2013, and they were granted on December 16th, 2008. On December 16th, 2009, the day before expatriation, the fair market value of Corp Z stock is $30. Restricted stock units are treated as substantially vested on December 16th, 2009, the day before expatriation, under Section 877 Cap A, D2, Cap A, Roman numeral 2, and the value of such gifts is the value of such units is includable in C's income on December 16th, 2009. What this means is, although in reality, the substantial risk of forfeiture has not lapsed, and under ordinary tax rules, C would not be including this income, because C is a covered expatriate and has this deferred compensation item, C must include $3,000 of income for the unvested RSUs on his 2009 tax return. Now, as I mentioned before, this is the default tax result, and it doesn't necessarily have to be this way if Corporation Z is a U.S. company. The first thing you do when you have a deferred compensation item is you check whether it's what's called eligible deferred compensation or ineligible deferred compensation. For it to be eligible deferred compensation, there are two requirements, and it has to meet both of them. The payer has to be a U.S. person or a foreign person who elects to be treated as a U.S. person for this purpose, and the covered expatriate has to give the payer Form W8CE within 30 days of the expatriation date. And if you fail one or both of these requirements, then it's ineligible deferred compensation. Now, if we go back to the previous slide, assuming that Corporation Z is a U.S. corporation, then in this situation, it's not inevitable that C has to pay tax on the $3,000 of income from unvested RSUs. If C makes the election for this deferred compensation item to be eligible, if Corporation Z is a U.S. payer, then they can avoid this treatment. Skipping ahead to slide 29, here's what I mean by that. This is how eligible deferred compensation is taxed. First and most importantly, there is no exit tax, in quotes, for this subset of deferred compensation. Instead, the covered expatriate is a non-resident alien after expatriation, and the normal tax rules for non-resident aliens apply. You can use treaties to change the taxation of eligible deferred compensation items. For example, it's common for a treaty to contain a provision that these types of items are taxed only in the taxpayer's country of residence. Note that you are not able to change the withholding rules by treaty. You have to comply with those, but you are able to use the treaties to modify the taxation rules. Now, for ineligible deferred compensation, this is where you have the deemed lump sum distribution of the present value of accrued benefits, and it's deemed received on the day before expatriation. You use the present value computation methods found in Notice 2009-85, Section 5, Paragraph D. You also have to pretend that other deferred compensation, including unvested benefits, vested or became yours on the day before expatriation. Now, I mentioned before you cannot make any treaty claims to reduce withholding. So when you get a payment from an eligible deferred compensation item, you have to have 30% of the taxable payment withheld. This can be a little bit silly because if you're able to use a treaty to get the tax treatment where your deferred compensation item is taxed in the other country instead, you can't do anything to reduce the withholding, even though the tax liability might be zero. This creates a situation where if you keep your U.S. Deferred compensation items after expatriation, then you'll be having tax withheld at 30% every year, and you'll have to file a Form 1040-NR to get the withheld tax refunded. Kind of a pain, kind of annoying, but unfortunately that's what the rule is. Next, we have the third type of exit tax that could apply to covered expatriates. And this is a situation where if you have a foreign non-grantor trust its distribution, then you have to deal with a pay-as-you-go withholding on any distributions received. Note that this withholding rule applies to distributions from all non-grantor trusts, foreign or domestic. Withholding is 30% of the taxable portion of the trust distributions, and taxable portions means do the math while pretending that the covered expatriate is still a U.S. citizen or resident. Note that we're talking about withholding only. This is just what the payer has to withhold. But when we talk about taxation, the covered expatriate is a non-resident alien. We're not pretending that they're a U.S. citizen for this purpose. Compute the tax liability using Section 871 for non-resident alien taxation. Then, if the distribution contains U.S. source income, the beneficiary is taxed under those principles, and if the trust distribution is foreign source income, then the beneficiary has no tax liability. The result, just like some of the deferred compensation items, you end up having to file Form 1040-NR to claim tax refunds. This brings us to the fourth type of exit tax that could apply to covered expatriates. And this is the one that is probably most commonly thought of as the exit tax, or that's what most people mean when they say exit tax. Under this one, you have to pretend that you sold everything you own, well, everything other than the previous three types of assets we talked about, recognize gain or loss, and then any capital gain you have to pay tax on. So the elements of this are you have a pretend disposition with gain or loss recognition. There is a special basis rule for green card holders. There's an exemption amount and a rule for allocating that exemption among your assets. And then lastly, there is a not very commonly used tax payment deferral option. So what assets does it apply to? This is the catch-all, so it applies to everything. The only things it doesn't apply to are the things that have their own special rules. Those are the specified tax-deferred accounts, deferred compensation items, and beneficial interests in non-grantor trusts. So what do we really mean when we say everything? It means, ask yourself this question. Would it be includable in your gross estate if you died on the day before expatriating? And then also, if you're a beneficiary of a trust that's not part of your gross estate, you have to include the value of that beneficial interest as well. So how do you know what sale price to use? You haven't actually sold anything. We're just talking about a pretend sale. You have to figure out what's the fair market value of your assets and pretend you sold them for that amount. You use estate tax principles to determine fair market value, and there's some special modifications to that found in Notice 2009-85, Section 3, Paragraph A. There are a couple notable exceptions. One is that beneficial interests in trusts are valued using gift tax principles, and life insurance policies are also valued using gift tax rules. For your basis, you use the basis that you would normally compute under the normal rules for computing basis. Note that for green card holders, there is an exception where they can elect for basis to be the fair market value of assets they owned on the first day they became a resident alien, not just a green card holder, any type of resident alien. But green card holders can't elect that first day of resident alien status basis for U.S. real property interests. So when you apply the mark-to-market rules, losses are recognized where they normally would be. The notable exception is personal assets like a personal residence. Also, the wash sale rules do not apply, and we generally take the position that a sale is a sale, even deemed sales, so that this unlocks suspended passive activity losses. We've filed returns taking this position, and so far we have not been told that we can't do that. Also, of course, use your NOLs if you're able to. So because of this Section 877 Cap A, Paragraph A, we are recognizing gain or loss on all the mark-to-market assets, so all the stuff that's not deferred compensation, specified tax-deferred accounts, or non-grant or trust interests. So we have this gain recognition, but the character of the gain or loss is determined by the regular rules of the Internal Revenue Code. And the first $744,000 of gain is tax-free. That amount is indexed for inflations and changes a little bit every year. And note that you have to allocate this pro rata across all gain items. You can't pick and choose, and you also have to allocate it to your gains before you net any applicable losses, like in the capital gain and loss category, for example. There is an option to defer the payment of exit tax that I have not yet personally used with a client because the procedure and the cost just hasn't been worth it for anyone I've worked with yet. There's some paperwork to do. You have to post security, so you might have to buy a surety bond. You have to pay interest at the standard rates on the unpaid tax liability. And note that this deferral is allowed on mark-to-market tax liability only, not on the tax liability triggered by specified tax-deferred accounts, deferred compensation, or trust distributions. So that's it for the 4 exit taxes that you have to worry about as a covered expatriate. After you've expatriated, after you've dealt with your exit tax, what happens is that you simply become a non-resident alien for tax purposes moving forward. Unless, of course, you re-immigrate back to the U.S., and become a resident alien again, but generally when people expatriate, they do that intentionally and do it with the goal of remaining outside the U.S. So I don't want to really go into much detail about how non-resident alien individuals are taxed. We're going to cover this very briefly. Non-residents are taxed on 2 different types of income. One is income effectively connected with a U.S. trade or business, and the other income they pay tax on is U.S. source income that's not effectively connected with the U.S. trade or business, like dividend income from their stock trading account. There's, of course, a whole world we can go into with the definition of a U.S. trade or business, but that's not really the topic for today, so I'm just going to assume everyone's familiar with that term. So because there are 2 different types of income that non-residents are taxed on, there are 2 different ways that they are taxed. On the income that's effectively connected with a U.S. trade or business, they're taxed at graduated tax rates, and they're allowed to take deductions. And on the income that's U.S. source income but not effectively connected, they pay a 30% flat rate on gross income with no deductions, but many times a treaty rate applies. So if you're in a country with a U.S. tax treaty, this is a perfect situation where you would want to use it. And then if you're a covered expatriate, yes, you're taxed like a non-resident, but you might have some special basis adjustments from when you paid exit tax. Mark-to-market property, you need to increase basis for gains recognized, or I suppose for losses recognized as well. A common question is whether you're supposed to adjust for the gain exclusion claimed, and the answer is no. The adjustment is determined without regard to the exclusion. For both ineligible deferred compensation and for specified tax deferred accounts, both of the two items where you have the deemed distribution and you have to pay tax on it as if it was actually distributed, for those the rule is to make, quote, appropriate adjustments. And there is very little guidance as to what appropriate adjustments means, but essentially you're allowed to make sure that the same income is not taxed twice. Of course, as a covered expatriate, there are going to be some double taxation issues that you aren't able to solve using protections found in the code or in Notice 2009-85 or using foreign tax credits. There might be other examples, but I'm giving two really notable examples here in this presentation. The first is foreign real estate. So if you're a covered expatriate, you have a deemed sale at the time of your expatriation. Then, of course, you still have the property, and you may actually sell it later, and doing so might incur tax in the foreign country. Generally, you're not going to be able to get any credit for the exit tax you paid in the US when you actually sell the property, because you weren't paying a tax for selling the property, you were paying this exit tax. So this is a common problem for people who expatriate and own foreign real estate. Another very common issue is with foreign pensions. So if you remember from our conversation about deferred compensation, one of the requirements for eligible deferred compensation is that it has to be from a U.S. payer. So if you're dealing with a foreign pension, then almost always it's going to be ineligible deferred compensation. That means you get hit with the deemed distribution of present value on the day before expatriation date. Then, as actual distributions take place, there's no tax credit available for the U.S. exit tax on a pretend distribution. I included this stuff here as a kind of catch-all for other things that covered expatriates need to be aware of. So there's a termination of deferrals from like-kind exchanges and involuntary conversions. Basically, any deferrals that existed immediately become due and payable. Same for Section 367A gain recognition agreements. Expatriation is a triggering event that causes gain recognition to occur. I mentioned earlier Section 684. That's where contributions to foreign trusts are subject to gain recognition. There's an ordering rule that just says that if that's your situation because of expatriation, then you apply that rule sequentially before you apply the 877A rules. And then lastly, there's a rule about Section 897. And Section 897 is where you have the rules about withholding from the sale of U.S. real property interests. Notice 2009-85 states that it does not apply to U.S. real estate subject to the mark-to-market deemed sale. Of course, if you hold on to that real estate and sell it later, it will apply to the real sale that happens later on. This brings us to our final section, and this is all about the tax on covered gifts and bequests. This is the tax that is assessed on U.S. citizens or residents for receiving a gift or inheritance from a covered expatriate. And this is the one where if exit tax is not a problem and otherwise, someone's able to expatriate, maybe they're going to be a covered expatriate, but they get to use the gain exclusion. They don't have many foreign pensions, so they don't have to deal with the ineligible deferred compensation rules. This is the one where if the exit tax rules didn't catch you before, they might catch you here, and this is where it might be really undesirable to be a covered expatriate. These rules all come from Section 2801, Section 2801, and the target of these rules is a gift or a bequest that goes from a covered expatriate to a U.S. recipient. The goal of these rules appears to be making expatriation tax neutral. So here's what I mean by that. If you look on the right-hand side of the slide, under where it says estate tax, this is how things normally work. You have a U.S. citizen, he has $100, and when he dies, 40 of that is going to go to the IRS, and the remaining 60 goes free of tax to the U.S. recipient, free of tax from the U.S. recipient's perspective anyway. Now, under the Section 2801 tax, this is the section on the left, you have the covered expatriate who has $100. He gives it all to the U.S. recipient, but the only person here within the IRS's reach is the U.S. recipient. The IRS doesn't have the covered expatriate within its reach anymore. So the person responsible for paying the $40 of tax to the IRS becomes, instead of the person giving away the stuff, it's the recipient. The basic equation to incur the Section 2801 tax is that you have to have a covered expatriate, there has to be a U.S. recipient, and it has to be what's called a covered gift or bequest. If you have all three of these things, then you have a situation where the recipient owes Section 2801 tax liability. So because we have these three elements, a covered expatriate, a U.S. recipient, and a covered gift or bequest, we're going to cover each of these one at a time, starting with the one that has the yellow box around it, covered expatriate. For purposes of Section 2801, this has the same definition that's used for income tax purposes from Section 877 Cap A. So it's the same thing we've been talking about all along, a covered expatriate. An exception for the covered gift or bequest rules is that if the covered expatriate becomes a U.S. resident or citizen again, then they don't have to deal with this during that time that they're a U.S. resident or citizen. And for these purposes, for the Section 2801 purposes, we're using the estate and gift tax definition of resident, meaning that it's a domicile test, not the count the days under the substantial presence rules or the do you have a green card test. So what do we mean by U.S. domicile? There are, of course, some court cases that we can look at, and also IRS regulation, which says that a person acquires a domicile in a place by living there for even a brief period of time with no definite present intention of later removing therefrom. So it's a facts and circumstances test, and it can be a little bit slippery, as sometimes facts and circumstances tests can be. But there's pretty significant case law in this area, so you should be able to figure out whether you would be domiciled in the U.S. or not when you're looking at these rules. So that creates a situation where one possible way of solving the Section 2801 problem is that you could reestablish U.S. domicile to either give away your assets or to die. So once again, look at the right-hand side of the screen first. Actually, let's look at the left side first. So this is the Section 2801 rules. You have a covered expatriate. They have $3 million and they want to leave all of it to a U.S. recipient. Of course, because of the covered gift or bequest rules, the U.S. recipient gets the $3 million, then has to pay 1.2 to the IRS and only gets to keep 1.8. But let's say that that same covered expatriate reestablished U.S. domicile. That means they get the unified credit, and assuming they've never used any of it before, that means that for the Section 2801 purposes, they don't have to deal with the recipient paying the gift tax. And because they're under the unified credit, they don't have to pay any estate tax to the IRS. So in this situation, the no longer covered expatriate is able to pass $3 million to the U.S. recipient, and nobody has to pay any tax. Next, we're going to define who is a U.S. recipient, because as mentioned before, you have to have all three elements for the Section 2801 tax to apply: covered expatriate, covered gift or bequest, and U.S. recipient. In the proposed regulations, they give some guidance for who exactly this could be. On this slide, we've put all of these in green. So it could be a U.S. citizen or resident. It could be a domestic trust, a foreign trust that elects domestic status, a U.S. beneficiary of a foreign trust, a U.S. owner of a domestic entity, and then if there's a foreign entity involved, that one actually is undefined at the moment. But anybody who's in green on this page, any one of these parties, would have to worry about whether they have to pay Section 2801 tax whenever they receive a covered gift or bequest from a covered expatriate. Now, one very common way to skirt around having to pay tax or report things is to use a nominee. Now, does this really work? I think not, because what you have here is the story you want to tell the IRS is that the money is coming from an unrelated person to you, but if the real story is that it's coming from a covered expatriate through an unrelated person to you, but it's really coming from a covered expatriate, then I think in that situation you really do still have to deal with the Section 2801 tax. So lastly, we have to look at what is a covered gift or bequest. Because if you have a covered expatriate, and if you have another U.S. person, there's no Section 2801 tax unless a covered gift or bequest passes between them. So what does that mean exactly? It has to be a gift in order to be a covered gift. Basically, this is going to be anything from a covered expatriate. But we do apply the usual definition for what is a gift. Covered gifts and bequests mean any transfers coming from a covered expatriate directly or indirectly through a nominee to anyone. It's only when the covered gift or bequest touches a U.S. recipient that it actually creates the Section 2801 tax liability. So how do you get around these rules? There are some things that people commonly think of that are ways to give gifts but without incurring gift tax. But for the covered gifts or bequests, there are these exceptions you can't use. So, for example, you can't use transfers of intangibles by non-residents. You can't use payments of school and medical expenses. And there's a few other uncommon exceptions as well. But there are some exceptions that do work. For example, one way to transfer property is at fair market value. In other words, you receive consideration in exchange for the asset you're giving. That's not really a gift because you're getting something in return. you do still get to use the annual small gift exclusion from Section 2503B. An amount smaller than that threshold is still a covered gift, but the tax doesn't apply to amounts below that threshold. I think currently that amount is $15,000 per year that you can give away. Another exception that works is gifts that are otherwise subject to the gift tax and reported on a timely gift tax return. And of course, gifts made while the covered expatriate is a U.S. resident. So in some situations, if there is someone who expatriated and incurred these rules unknowingly, perhaps they have an opportunity to come back to the U.S. and establish U.S. domicile and make some gifts then before leaving again. There are other exceptions that work as well. Probably the biggest and most important is marital deduction transfers to U.S. citizen spouses. So if you are a covered expatriate and your spouse remains a U.S. citizen, you can still make transfers to your U.S. citizen spouse and they will not have to pay the Section 2801 tax. Another thing that works is qualified domestic trusts for bequests to non-citizen spouses. And then also, you can use the gift exclusion for gifts to non-citizen spouses under Section 2523I2. And this is a situation you could use if you have a green card holder spouse living abroad. And then lastly, you can always make charitable transfers. So we've looked at what these three things mean: covered expatriate, covered gift or bequest, and U.S. recipient. And you have to have all three in place to incur the Section 2801 tax. Now it's important to note that as of right now, Form 708, where you would report and pay this tax, it has not yet been published, and it is supposed to be published when the proposed regulations are final. I don't know when that's going to be, but at the moment, there's no filing requirement until the final regulations are published, and there's no payment of tax required until the final regulations are published. And we don't know if the person who's going to be responsible for the Section 2801 tax is going to have to go back in time and report gifts retroactively and pay tax for previous years. So we don't recommend using the fact that these regulations are not published and this requirement is not, the payment of tax is not required yet. We don't recommend using that as a way to make big gifts right now and think that you won't have to deal with it, because you might. Under Section 2801, the tax liability calculations, you use the fair market value of the covered gift or bequest received, minus the annual exclusion amount, multiply that by the highest estate or gift tax rate in effect when the covered gift or bequest was received. And you do get to take a credit for foreign gift or estate taxes paid on the covered gift or bequest. And with that, we are at the end of the presentation. I have a disclaimer slide here. More importantly, my contact information. If there's any questions I didn't cover today, please feel free to reach out to me, email address at the bottom. And just as a quick summary, we went over the context for what's an expatriate, how do you become one, what does it mean to be covered. Then we talked about the 4 different types of exit tax. We talked about how non-residents are taxed in general. Talked about a couple of the specific problems that covered expatriates face. And then we talked about the tax on covered gifts or bequests from covered expatriates to U.S. citizens or residents. Thanks everybody for listening, and have a great day.